Good morning, dear students. So, in this second term, let us study chapter number 10 Banks and Simple Interest. Let's recall a bank is a government recognized institution that carries out transactions of money. Banks make it easier to plan the use of money, that is, to do financial planning. So, these first two lines you can mark as a definition of a bank. So, again, let me read it again. Now, what do you mean by a bank? A bank is a government recognized institution that carries out transactions of money. Banks make it easier to plan the use of money, that is, to do financial planning. We can either deposit cash money in a bank or withdraw cash from it. For that purpose, we must open an account in a bank. Bank accounts are of various kinds. So let's learn different types of accounts. The first type is the current account. Now, what do you mean by a current account? A current account is mainly for traders and those dealing in money on a daily basis. An account holder can deposit or withdraw money any number of times in a day. So you can mark this definition of current account. So in a current account, we can understand that the person or the account holder can deposit or withdraw money any number of times in a day. So mostly the business people have current accounts. The bank issues a passbook for this account and also a checkbook on demand. The bank does not pay any interest on the money in this type of account. Money can also be withdrawn or deposited by check. So I hope you have followed current account. Now let's go to the second account called as a savings account. A person can deposit a minimum amount and open a savings account. In some banks, no minimum amount is required for opening an account. So you can mark the definition, these first two lines of savings account. The bank pays some interest on the basis of daily credit balance in the account. There are some restrictions and how often money can be withdrawn from this account. For this account too, the bank issues a passbook and on demand a checkbook. Okay. Third type of account is called as the recurring account or recurring deposit account. The account holder can decide the amount to be deposited every month in the account. Okay, so here you can mark this first line as the definition, in which this recurring account, the bank gives an interest on the deposit which is more than that paid for the savings account. Such an account is a means of compulsory saving. So it is a very good habit of saving money. So every month you can deposit certain amount which you have decided. So it is compulsory saving. Often it is convenient to have a joint account for, say, husband and wife or guardian and ward, etc. Besides, accounts of business partners, housing societies, trusts of voluntary agencies, etc. are required to be operated by more than one person. Now, let us go to fixed deposit. Now, what do you mean by fixed deposit? A depositor deposits a certain amount for a fixed period in a bank. For example, you can deposit certain amount, say 1000 rupees for 1 year. Okay, so you are a depositor and for 1 year you are depositing in a bank. Now this deposit attracts a greater rate of interest than the savings account. So here you get more rate of interest than the savings account because you are keeping it for a fixed period of time. However, these rates are different in different banks. Senior citizens get a slightly greater rate of interest than the usual. So I hope you have followed the different types of account and fixed deposit. Now, ATM, credit and debit cards. An ATM, that is automatic teller machine, card is used to withdraw cash without going to a bank. Okay, so nowadays you are quite familiar, you have seen the ATM cards, and now we are having a cashless or transactions. People due to COVID are not visiting the banks often. They are trying to do net banking, mobile banking, etc. in order to avoid contact. A credit card or a debit card is used to carry out transactions without using cash. An account holder can get such a card on request to the bank. So students, here you can ask your parents about the savings account, recurring account or fixed deposit and ATM cards. You can just ask, if they wish to show you, they will show you, which will add up to your knowledge. Now let us go to the next page, in which let us discuss about a passbook. So have you seen a passbook? I hope so. Observe the entries made in the page of a passbook shown below. Now here the lines are given, the dates are given on which day the transaction is carried out, the particulars, whether you have cash, it is deposited, 1500 rupees cash was deposited and the balance was 7000 rupees. Then on 8th of Feb 2016, a check was deposited. The number of the check was given 232069 and deposited 5000 rupees with the check. Total balance was 12,000. So here, like this, the fourth one, particulars, self and withdrawn. How much money was withdrawn? 1500 rupees. So now the balance has gone to 7500 rupees. Now on 26/2/2016, with interest, you got interest on that, 135 rupees. So the total balance is 7635 rupees. So I hope you have followed this page of the passbook. Now here, let's fill in the blanks. You can take your pencil and you can write down there. On 2/2/16, the amount deposited was 1500 rupees and the balance was 7000 rupees. On 12/2/16, 3000 rupees were withdrawn by check number 243965. The balance was 9000 rupees. On 26/2/2016, the bank paid an interest of rupees 135 rupees. A passbook is issued for a savings account and a recurring deposit account. Amounts deposited, withdrawn and balance are recorded in it with their dues. Now this activity is shown, it is cancelled. So you can delete that activity. Okay. Now let us go and see the next page. The first picture you can see over there. Okay. The man and the woman are shown. That is a passbook. The picture of a passbook of Bharat Cooperative Bank. This is a savings bank account passbook. The second picture is of a slip for paying cash or check, the details of which have to be filled in. And the third picture is the behind side of the same slip in which you fill again the details. Now again, let us go back to page number 70. Okay. Now let's recall. Suvidha borrowed a sum of 30,000 rupees at 8 PCPA. Excuse me. Interest for a year from her bank to buy a computer. At the end of the period, she had to pay back an amount of rupees 2400 rupees over and above what she had borrowed. Based on this information, fill in the boxes below. So, just take your pencil and write down. Principal is rupees 30,000. Rate of interest is 8%. Interest is rupees 2,400. Time 1 year. The total amount returned to the bank is equal to 30,000 plus 2,400 is equal to 32,400. So I hope you have followed this. Now let us learn more. We added the capital and the interest occurred on it to find out the amount that Subhida returned to the bank. Thus, principal plus interest is equal to total amount. Okay, this formula you should know. Principal plus interest is equal to amount. You have to learn that. Now let us go to the next page. Next example. Neha took a loan of 50,000 rupees at 12 PCPA to buy a two-wheeler. What amount will she return to the bank at the end of 1 year? The amount, that is the total money owed to the bank at the end of the time, is to be calculated here. The principal is 50,000 rupees at 12% per annum. PCPA is percent per annum. The interest on 100 rupees for 1 year is 12 rupees. We shall write the ratio of the interest to capital in two ways to obtain an equation. On 50,000 rupees, let the interest be X rupees. On 100 rupees, the interest is 12 rupees. So, X upon 50,000 is equal to 12 upon 100. So, X upon 50,000. Now, you have to get rid of 50,000. So, we multiply both sides of the equation by 50,000. So, therefore, X upon 50,000 into 50,000 is equal to 12 upon 100 into 50,000. So, 50,000 on the first side gets cancelled, that is X upon 50,000 into 50,000. So, both get cancelled. So, after solving this, you get X is equal to 6,000. So, amount to be returned to the bank is equal to principal plus interest. So, the principal is 50,000 rupees plus 6,000. So, if you add it, you get the amount to be returned to the bank is rupees 56,000. So, now let us go to the second example. Akash deposit 25,000 rupees in a bank at a rate of 10 PCPA for 3 years. How much interest does he get every year? And how much altogether? So, let us find the solution for this problem. So, solution, here the principal is 25,000 rupees, time is 3 years and rate of interest is 8 on 100 rupees. The interest on 100 rupees is 8 rupees. So, let us suppose the interest on 25,000 rupees for 1 year is X. So, let us find out the ratio of interest to principal. Okay. So, X upon 25,000 is equal to 8 upon 100. Therefore, multiplying both sides of the equation by 25,000, X upon 25,000 into 25,000 is equal to 8 upon 100 into 25,000. So, after solving this, you get X equal to 2,000. Akash got 2,000 rupees interest for 1 year. For 3 years, he got 2,000 into 3, that is 6,000 rupees interest. Now, let us go to the next page. Now, let's learn. Let's learn the formula used to solve the problems based on simple interest. The principal is the same every year and the rate of interest too remains the same. The interest calculated in this way is called as simple interest. So put a bracket for this two lines. Now let us calculate the total interest when the principal is P is deposited for T years at R, the rate of interest. Suppose the rate for 1 year is I, capital I. Now the ratio of the interest to principal for 1 year is I upon P, that is interest upon principal, is equal to R upon 100. Therefore, I is equal to P into R upon 100. Therefore, interest for T years is equal to I into T, that is equal to P into R into T upon 100. So, total interest is equal to principal into rate into time upon 100. So, P stands for principal, R stands for rate, and T stands for time. So, this is the formula which you should learn. You should know it. Now, solving the same example using the formula. Now, principal P is equal to 25,000. R, that is the rate, is 8 and time is equal to 3 years. Now, total interest is equal to P into R into T upon 100. So, that is equal to 25,000 into 8 into 3. So, here after solving, that is cancelling the two zeros of 100 and 25,000. You solve it, you get 6,000 rupees. So, total interest is 6,000 rupees. Now, I know total interest is equal to P into T into R upon 100, where P is the principal, T is the time in years, R is the rate of interest. So, you should know this formula. You have to learn this formula from the blue box. Now, let's go to the next example here. Sandeep Bhau borrowed 1,20,000 rupees from a bank for 4 years at the rate of 8.5 PCPA for his son's education. What is the total amount he returned to the bank at the end of that period? Now, solution. Principal 1,20,000, P, that is 1,20,000, R, that is rate 8.5, and T is equal to 4, time. So, total interest, that is the formula, is equal to P into R into T upon 100. So, that is equal to 1,20,000 into 8.5 into 4 upon 100. So 1,20,000 into 85. We want to remove the decimal point. So, we multiply by 10. So, both the numerator and the denominator. So, it becomes 85 into 4 upon 100 into 10. So, after cancelling 3 zeros, 100, 2 zeros and 110 0. So, these 3 zeros from the denominator and cancel the 3 zeros from the numerator of 1,20,000. And after multiplying them, you get 120 into 85 into 4. That is 40,800. So, the total amount returned to the bank is 1,20,000 plus 40,800. So, it comes to 1,60,000 rupees. So, I hope you have followed these examples.